You know what an index fund is. You know that for most people, it's the smart, simple, and passive way to build long-term wealth. But you're still curious. You see stocks like Apple, Tesla, or Amazon in the news every single day. And you want to know, how does someone actually analyze that stock? How do you know if a stock is good or bad? How do you know if it's cheap or expensive? Is there a secret? Is it a complex formula? In this video, I'm not going to give you confusing math. I am going to give you a simple 4-step framework that any beginner can use to analyze any business. This is Stock Picking 101. To start, I want you to forget the stock market. Seriously, forget the ticker symbols and the crazy flashing charts. I want you to imagine your neighbor is selling their local coffee shop, and you are thinking about buying it. What are the 4 things you would need to know before you write a check? Step 1. You'd want to understand the business. You would walk in. What do they sell? Just coffee? Or also expensive pastries? Is the coffee any good? Is the shop packed with loyal customers, or is it always empty? What makes it special? Is it the only coffee shop in town? That's a great sign. If there are 10 other coffee shops on the same street, that's a lot of competition. This is called the business model and the economic moat. Before you ever buy a stock, you must be able to answer, what does this company actually sell? And why do people keep buying it? What does Apple really sell? They sell premium, easy-to-use technology that all works together. Their moat is their brand, their ecosystem, and their loyal customers. If you can't explain what a company does in one simple sentence, you should not buy it. This moat is a company's durable competitive advantage. A brand like Coca-Cola is a moat. People buy it just for the name. A switching cost is a moat. Think about Microsoft. An entire company runs on Windows and Office. It would be incredibly difficult and expensive to switch to something else. A network effect is a moat. Everyone is on Facebook or Instagram because everyone is on Facebook or Instagram. A new social network, even with better features, can't compete. We are looking for businesses with deep, wide moats. Step 2. You'd want to check the books. Is it profitable? After you like the coffee, you'd ask the owner, show me the books. Are you actually making money? You would want to see 2 numbers. First, the revenue. How much money came in the door this year? Is that number growing? Second, the net profit. After paying for coffee beans, employees, and rent, how much money did the owner actually keep? This is the income statement. When we analyze a stock, we are not looking for companies that might be profitable one day. We are looking for real, boring, profitable businesses. We want to see companies with growing revenue and growing profits year after year. A coffee shop that's getting more popular and more profitable is a great sign. A business that's losing money is a red flag. Step 3. You'd want to check the debts. You're happy, the coffee is great, the profits are growing, but you're smart. You ask the owner, do you have any loans? Do you owe $50,000 on that fancy espresso machine? Are you drowning in debt? This is the balance sheet. It's a snapshot of what the company owns, its assets, like cash and factories, and what it owes, its liabilities, like debt. We are looking for companies with more assets than liabilities. A coffee shop, or a company, that is drowning in debt is a very risky purchase. If a recession hits, that debt could sink the entire business. We want strong, stable companies with a lot of cash on hand that can survive a bad year. Step 4. You'd want to check the price. Is it a good deal? This is the final and most important step. The coffee is great, the shop is profitable, and it has no debt. You're ready to buy. You ask the owner, how much? And the owner says, I want $1 million for this shop. You would laugh them out of the room. No way. This shop only makes $50,000 a year in profit. It would take me 20 years just to make my money back. In that moment, you just did a valuation. This is the PE ratio, or the price-to-earnings ratio. It is the single most famous number in investing. It's just the price of the stock, the $1 million, divided by its profits, the $50,000. In this case, $1 million divided by $50,000 is 20. The PE ratio is 20. This number tells you how expensive a stock is relative to its profits. A PE of 10 means you're paying $10 for every $1 of profit. That's a very fair price for your coffee shop. A PE of 100 means you're paying $100 for every $1 of profit. That is a very expensive stock. You are paying for decades of growth that might not ever happen. Now, this is where beginners get confused. You might ask, but what about a company like Tesla? Its PE ratio is often 60 or 70. Is it a terrible investment? This brings us to the problem with the PE ratio. It's a snapshot. It only tells you the price today compared to the profit last year. It doesn't account for growth. A PE of 70 is insane for a coffee shop that's growing 5% a year. But is it insane for a company whose profits are growing 50% a year? This is where a slightly more advanced, but simple, tool comes in, called the PEG ratio. This stands for price to earnings to growth. You just take the PE ratio and divide it by the company's profit growth rate. Let's say our coffee shop has a PE of 20, and its profit growth is 10% per year. You take 20, divide by 10, and you get a PEG ratio of 2. Now let's look at a growth stock. It has an expensive PE of 40, but its profit growth is 50% per year. You take 40, divide by 50, and you get a PEG ratio of 0.8. A PEG ratio of 1 is considered fairly valued. A PEG ratio under 1, like our 0.8, is considered undervalued or cheap relative to its growth. A PEG ratio over 1, like our 2, is considered overvalued. This simple tool helps you compare a boring stock to a growth stock. It's the next level of valuation. So, let's put our 4-step framework together. We are looking for a great business you can understand with a strong moat, a history of growing revenue and growing profits, a strong balance sheet with low debt, a fair price or a PE ratio that isn't insane, and a PEG ratio under 1 or 2 is even better. Now, you might be thinking, that sounds like a ton of work. And you're right, it is. You're also thinking, is it hard? Can I still be wrong? Yes, it's very hard, and yes, you can absolutely still be wrong. This is why 90% of professional stock pickers fail to beat the S&P 500. This is why Warren Buffett says you should buy an index fund. An index fund, like VOO or SPY, is just a basket that automatically buys 500 coffee shops that have already been checked for profits, growth, and stability. It is the simple, proven, and passive path to wealth. But if you are going to buy an individual stock, if you want to try and find the next great company, this is how you start. You stop gambling on ticker symbols you see in the news, and you start analyzing businesses like you're going to buy them. If this video helped you finally understand the basics of stock analysis, do me a favor and hit that like button. It tells the algorithm we're making high-quality, simple content for beginners. And be sure to subscribe, because our journey to building wealth is just getting started. Now, for my question, what one company have you always wanted to analyze? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.